Hi guys, and welcome back to my channel. I've been trading in the Forex market for 10 years, and today I will be explaining the different styles of Forex traders. Now this video is not restricted to just the Forex market. It can be applied to any markets such as the stock market or even the crypto market. Now before we get into the different styles of traders, it's important to know that in the trading world, you get people who follow technical analysis and or fundamental analysis. Now depending on what style of analysis a trader tends to follow will determine his or her style of trading. Individuals who try to navigate the Forex market using the technical analysis believe that all the information is in the chart. Then based on history and current price, it might be possible to figure out where the market is going to go next by using support and resistance, trend lines, indicators and candlesticks formations. Technical experts believe that history is going to repeat itself. For example, if there is a major resistance level that a target is getting ready to reach, a technical analyst may believe the market is getting ready to pull back. Then they may execute a trade based on this information. The goal is to look for similar patterns that have taken place in the past. Then, a technical analyst will make trades in this manner, believing that the market may act the same way as it did the last time and make a profit off of it. Technical analysis can be different for every trader. Each trader would have their own strategies, indicator setups, and opinions of where they think the major key price level is. These differences, along with each person's personalities, are known as a personal trading system, which is designed by the trader themselves. Technical analysis only makes up of a fraction of the necessary knowledge needed in order to be a successful trader. The next type of analysis is fundamental analysis traders, also known as news trading. This type of analysis is used by traders who predominantly rely upon the economic market news events releases to determine the directional bias and trade predictions. For example, these type of traders would wait for non-farm payrolls or aka NFPs, which basically measures the health of the United States job market. The better these results are, the stronger the dollar will get. Now along with NFPs, interest rates, GDP and CPI results are also used to determine these type of traders' bias. The methodology behind trading based on fundamental events is the theory that no matter what happens to the price of a currency in the short term, the price of your currency or investment will eventually follow the released economic data. However, many times the market seems to react differently to certain news events. For example, some high-impact Great British Pound data is released which reflects highly positive numbers, but the GBP-USD currency pair does not seem to move much or moves in the opposite direction of what was expected. Seeing this, many traders are left confused as to why that would happen. This confusion leads us to the topic of market manipulation. A large percentage of major fundamental news releases are only an excuse for the market makers to distort a trader's directional bias on a certain currency, consequently driving the trader to make mistakes and ultimately lose money. This is yet another reason as to why so many pro traders rely heavily upon technical analysis rather than fundamental analysis. Although many opt to use a combination of the two together. Traders who follow a fundamental trading approach can also be known as position traders. These traders could be in the same trade for months at a time, as it takes time for the fundamentals to take effect. Now if you have liked this content thus far, then please consider liking and subscribing to my channel. I'll greatly appreciate it. The next style of trading is swing trading, which is the style which is centered around executing trades based on the medium-term market views. Swing traders are those which are normally held anywhere from several days to several weeks. Trades which run for such periods of time are most often analyzed firsthand from a higher time frame chart such as the 4-hour, daily, weekly or monthly. Certain swing trading has been described as following a fundamental trading approach, as many corporate fundamentals generally require several days, even weeks, to sufficiently impact the market in a way which will allow these type of traders to make a profit. A trader who executes using a swing strategy will more often than not have a decent sized profit target alongside a fairly wide stop loss, thus allowing the trade to breathe. Swing trading is a great style for those who have other responsibilities and have a limited time to spend sitting in front of the charts. A set and forget strategy that does not necessitate daily management. This style of trading can be very profitable if you know what you're looking at and where to enter the market. Swing traders use a combination of fundamentals and technicals to determine their trades. The next style of trading is day trading. This is a highly common style for traders who aim to make a profit from the forex market on a daily basis. This style of trading tends to encourage bad habits, particularly for new traders. This boils down to impatience, as most day traders wish to use high leverage in an attempt to make big profits out of that particular daily move. When it comes to day trading, those traders who do not want to leave trades running overnight must be very disciplined in their stop placement and stick to targets with a respectable risk to reward ratio. The most liquid currency pairs such as Euro USD have an average daily range of around 70 to 90 pips. This means the movement can be limited throughout the trading sessions and positions sometimes need to be monitored closely in order to lock in profits. Many professional day traders practice a daily routine that can be a lot different to what many beginners imagine. When day trading, ideally you would want to select just one high probability trade on just a couple of currency pairs. And the final style of trading is scalping, which is a trading style that focuses on taking small profits in the shortest amount of time. Scalpers can place up to 100 trades in a single day, seeking small profits of just 5 to 10 pips on each trade. Because scalpers have to be glued to the charts, it is best suited for those who can spend several hours of undivided attention on their trading. The strategy behind scalping is that lots of small wins can easily translate into large gains. Scalping focuses on larger position sizes for smaller profits in the shortest period of holding time, from a few seconds to minutes. The objective of scalpers is to capture very small amounts of pips as frequently as possible throughout the day. This requires considerable focus and discipline, as scalpers have to closely monitor market movement and recognize opportunities for profits quickly. You'll only experience fatigue and burnout when staring at the charts for hours on end, which will in turn distort your judgment. Scalping fits into the category of technical analysis, as traders place their trades based on candlestick formation. Scalping is a term used to denote skimming of small profits on a regular basis by going in and out of position several times per day. As a scalper, you rely on much more frequent and shorter term trades, as it is a trading style that involves jumping in and out of positions, gaining or losing just a small amount. These trades could run for 60 seconds to 60 minutes. Some scalpers hold little regard for placement of stop losses, and the risk-reward ratio can often be a little putting off for experienced traders. Scalpers like to try and scalp between 5 and 10 pips each and every trade they make, and repeat this process over and over throughout the day. Using high leverage and making trades with just a few pips of profit at a time can add up, especially if your trades are profitable and can be repeated many times over the course of the day. Scalping is very fast-paced. If you like the action and like to focus on 1 or 2 minute charts, then scalping may be for you. Well, there you have it everyone. Those are the different styles of trading within the Forex market. Now, if you have liked today's video, then please consider liking and subscribing to my channel. I'll greatly appreciate it.